Hello, my name is Professor Vasudevan. Today we will talk about Chapter 2, and Chapter 2 deals with financial statements, taxes, and cash flows. So what are some of the things that we learn as part of this chapter? We will talk about the difference between book value and market value. We will talk about the difference between accounting income and cash flows, differences between average and marginal tax rates, and how to determine a firm's cash flow from the financial statements. I think from a conceptual point of view, it's a very important chapter, and this topic is mainly accounting, and we use the same concepts in chapter 10, and for exam 1 this is definitely a very important chapter. Okay? So what are the financial statements that we talk about? We will talk about the balance sheet, the income statement, and the cash flow statement. We'll also talk about how we can compute the taxes. So when people talk about the balance sheet, usually we refer to that as the snapshot of the firm. So basically it's like taking a picture, a financial picture of the firm. And all that we are doing is seeing how the firm is doing at a particular point of time. So it's not over a period of time, but it is over a certain point of view, okay, point of time. Now when you look at the balance sheet, basically we have the balance sheet identity. And what does it tell you? It tells you that on the left hand side we have the assets, and the right hand side we have the liabilities plus the shareholders equity. And what we say is that the left hand side of the balance sheet should be equal to the right hand side, or what it tells you is the assets of the firm are equal to the liabilities plus the stockholders equity. Or if we move things around a little bit, we can find that assets is equal to assets minus the liabilities is equal to the stockholders equity. So what that means here is that a firm, the stockholders are a residual claim, okay, and residual claim means that they get paid only after everybody else has been paid. So as an example, if the firm has assets worth $5 million, the liabilities are $3 million, the difference is $2 million, and that belongs to the bond stockholders. Okay. Now if the firm had owed $5 million in liabilities, then the stockholders equity would be 0. If the firm owes $6 million, again stockholders equity is 0. So what we are trying to say here is that stockholders get paid only after everybody else has been paid. Now if you look at the balance sheet, assets are listed in order of their decreasing liquidity. So the most liquid asset is cash, and that is the first item. And we are talking about how quickly they can be converted to cash without losing much value. So what we see here is that the balance sheet is given in figure 2.1, and the first item is current assets, and current assets has cash, you have inventory, we have accounts receivable. So these are the main components. On the right hand side we have the current liabilities, and the current liabilities we have the accounts payable, we have the notes payable. So these are the short-term payments outstanding. And after that, on the left hand side we have the fixed assets, and the fixed assets are the tangible fixed assets. So what are tangible fixed assets? Some examples are property, plant and equipment. And what are intangible fixed assets? Intangible fixed assets, some examples are patents, okay, copyright, and so on. So these are like a trademark is another example. So the trademark for Coke, that is an intangible fixed asset. So that has a lot of value. And on the right hand side we have the current liabilities, then we have the long-term debt, and we have the shareholders equity. So what we are saying is that the left hand side, what we have the assets arranged in the order of the liquidity, and on the right hand side we have the liabilities arranged in the order in which they have to be paid out. Now people always talk about working capital, people talk about working capital management. So what is that? The net working capital is the difference between the current assets and the current liabilities, and usually it's a positive number when the cash that will be received over the next 12 months exceeds the cash that will be paid out. So that is sometimes, when people talk about the solvency of a company or the ability to make its short-term payments, people look at the net working capital. Now, what is liquidity? Ability to convert to cash quickly without a significant loss in value. So what we find here is that clearly the most liquid asset is the cash itself. Liquid firms are less likely to experience financial distress, but liquid assets earn a lower return and trade off to find balance between liquid and illiquid assets. So as an example, if you go to a store, it could be a furniture store such as we have quite a few furniture stores in the New England. So Cardi's is a store close by to us. Okay. Then we have Mardi's Furniture. Okay. We have Bernie and Phil's. So these are some of the examples. So if you go to the store and you want to pick up a piece of furniture, they have a lot of items on display. But usually, once you decide on a furniture, they call the furniture manufacturer and place the order. So it might take 2 weeks, 4 weeks, or even longer to get the item. And the reason why they do that is because they don't want to spend a lot of money on furniture and keep it for you. They'd rather not have their money tied up. So that is what we see as the liquidity. Firms don't want to tie up too much cash, and they are really looking to place that burden on the manufacturer. Okay, so now what we have is we have the balance sheet of the firm, and what it tells you is that we have the balance sheet over 2 years, 2004 and 2005. Okay. And the first item for 2004 is the cash. The firm had 104 cash in 2004. It is 160 in 2005. The accounts receivable is 455 in 2004 and 688 in 2005. The inventory is 553 and 555. And total assets, the current assets are 1,112 in 2004 and 1,403 in 2005. When you look at the fixed plant and equipment, it is 1,644 million in 2004, and it has gone up to 1,709 in 2005. Now, on the right hand side, the liabilities, the accounts payable are 232 and 266 in 2004 and 5. The notes payable are 196 and 123, and total is 428 and 389. Now, the long-term debt is 408 in 2004 and 2005. Equity has gone up from 600 to 640, and retained earnings are also gone up by $300 million from 1,320 to 1,629. So if you step back and look at the changes of the firm over the 1 year period, what is the most significant change? Is it good or bad? Or what are some of the most significant changes? So some of the significant changes are, if you look at the liabilities, the accounts payable has gone up a little bit from 230 to 266. The notes payable has gone down. That's a good thing. The firm has refinanced and paid off some of the short-term debt. The long-term debt has gone up a little bit from 408 to 454. So maybe it refinanced the short-term debt by issuing long-term debt, and retained earnings has gone up substantially by $300 million. So all those seem to be good things. What about the left-hand side? The cash has gone up by $56 million. The accounts receivable has gone up from 455 to 688. So that is perhaps the only item that can ring some bells. You want to be careful about that. And the reason being that, why is it that the firm's accounts receivable has gone up so much? There are a couple of reasons for that. One could be the firm has improved the sales, increased the sales, and because of that, the accounts receivable went up a lot. Or it could be that the firm has become a little more lax as far as the accounts receivable policy is concerned. Now, if the accounts receivable has gone up because of the laxity or because the firm has gone lax, that's not a very good thing. So that is something you have to be concerned about. And the reason why I say that could be true is because if you look at the fixed assets, it has not gone up a lot. So usually if sales go up a lot, your fixed assets also has to go up. So chances are the firm has to examine the accounts receivable policy. Okay. So we talked about the balance sheet, and the balance sheet provides the financial picture of the firm, and it gives you the book value of the assets, liabilities, and equity. Now in finance, people place more emphasis on market values. So what is market value and what is book value? So market value is something that somebody is willing to pay. So how much are they willing to pay for the property, plant, and equipment? How much are they willing to pay for the stock? How much are they willing to pay for the bonds? These are the market values. Now the book values are mainly for accounting purposes, for tax purposes, and so on. Now market value and book value are often very different. Why? Which is more important to the decision making process. So market value and book value are different mainly because the book values are basically set up when a firm is incorporated, and book values can go down as time passes, and the reason why the book values go down is because of depreciation. So the IRS gives you some leeway as far as depreciation is concerned. So for example, I think the building, if you have a building, it's depreciated at 3% roughly. It's depreciated over 30 years, which means that every year the value of the building will go down by 3%. In practice, it all depends upon the market whether the value of the building is going up or going down. And secondly, the book value of the stock is mainly for accounting purposes. What really matters is how much investors are willing to pay for the company's stock. So these are some of the reasons why you find some big differences. And as I told you before, as far as finance is concerned, we place more emphasis on market value. Okay. So let's compare these numbers. We have a company, Klingon Corporation, and the net working capital is 400 million in that is the book value. The market value is 600. So where could the big difference be? If you look at the difference, chances are that comes from inventory. So cash, there's not going to be any difference. Accounts receivable, there could be a little bit of a difference, but not so much. And the chances are that is the inventory. What about the fixed assets? It's 700 million on the books. It's 1,000 million on the market value. So again, there's a big difference. What about the long-term debt? Usually, there may not be much of a difference in the case of the bonds or the long-term debt. Shareholders' equity, you will find a big difference. And the market value equity usually tends to be much higher than the book values. Okay. So we talked about the balance sheet, and the balance sheet is like the financial picture of the firm. Now, if you look at the income statement, we are looking at the performance of the firm over a longer period of time. So that could be 1 year, that could be 3 months, that could be 6 months, and so on. And here, it's like taking a movie, or it's like a video of the firm's operations for a specified period of time. Now, what is the income statement? What are some of the practices? You generally report revenues first and then deduct any expenses for the period. Matching principle, GAAP says to show revenue when it accrues and match the expenses required to generate the revenue. So here is an income statement. So the first item we have is the sales. The firm had 1,509 million in sales. The next is the cost of goods sold. So the cost of goods sold is roughly 50% of the sales. So that is how much it is costing the firm to manufacture the item and so on. Depreciation is 65, and EBIT, or the earnings before interest and taxes, is 694. The interest paid is 70 million, and the taxable income is 624. Okay, the taxes paid are 212, and then the net income is 412. So taxes are paid on the 624 million. Now, out of the 412 million, the firm makes a net income. 103 is paid as a dividend, and 309 is paid as a addition added to retained earnings. So sometimes people refer to that as the payout ratio. So out of the 412 million in earnings, 103 is being paid out as a dividend. So basically here we are saying that 25 cents on the dollar is being paid out as a dividend, and 75 cents is being retained within the firm. The next item we have is the taxes, and what we say here is that the thing that we can rely on with taxes is that they are always changing. So, one of the sayings is that you cannot avoid paying taxes, nor can you avoid death. So both of them are inevitable. Okay. And when you talk about taxes, we have the marginal versus the average tax rate. Marginal tax rate, the percentage paid on the next dollar earned. So basically here what we are saying is that for this firm, how much are they going to pay in taxes for the next dollar? Okay. While the average tax rate, the tax bill divided by the taxable income. So if you go back, on average, what has been the tax being paid? So what is the difference here? Usually when you're trying to analyze a firm, what is really important is the marginal tax rate. So the cost of the next dollar. And the reason being that perhaps for the next year, the tax rate has changed. The tax policy has changed. Tax rules have changed, which means that the marginal tax rate becomes far more important than the average tax rate for the past year. Okay. Suppose your firm earns 4 million in taxable income. What is the average tax rate? What is the marginal tax rate? So the firm's average tax rate would be the 4 million. You want to go back and look at how much taxes was paid. Divide that by the 4 million. That gives you the average tax rate. Okay. Now we want to talk about the concept of cash flow. I think as far as this chapter is concerned, perhaps that is the most important concept. Okay. And cash flow is one of the most important piece of information that a financial manager can derive from financial statements. So one of the things I tell people is that to be a good finance person, you also should have a good background in accounting. So you want to take your accounting seriously, because if you can know accounting well, I think finance becomes a lot easier. It becomes a lot more practical, and in terms of a job and so on, I think that's very important. Okay? The statement of cash flows does not provide us with the same information that we are looking at here. We will look at how cash is generated from utilizing assets and how it is paid to those that finance the purchase of the asset. So basically here, what we are saying is that if you go back to the balance sheet, on the left hand side we had the assets, on the right hand side we had the debt, and then we had the equity. Here what we are doing is that we are talking about how we can use the assets. The cash flow from the assets is being split between these two parties. Part of it goes to the bondholders and part of it goes to the stockholders. Okay. So that's what we see here. The cash flow from the assets is equal to the cash flow to the creditors plus the cash flow to the stockholders. Now what we need to do now is, how do we define the cash flow from the assets? So the cash flow from the assets is given by the operating cash flow minus the net capital spending minus the changes in the net working capital. So what we want to do for the next 2 or 3 slides is, we want to define operating cash flow, we want to define net capital spending, and we want to define net working capital. And what we see is that we do some problems based on that, and chances are you will get some problems for the assignments as well as the exam. So you want to make sure you are comfortable with this material. Okay. So what is the operating cash flow? The operating cash flow is given by the earnings before interest and taxes minus taxes plus depreciation. So EBIT, that is the earnings before interest and taxes. And why do we look at EBIT? Basically, we want to compare the performance of the firms without looking at the amount of debt they have. So sometimes borrowing a lot of money can create problems for a firm. That can lead to distress. But here we are ignoring that. Why do we add back the depreciation? The reason why we add back the depreciation is because depreciation is not a cash flow. And then we take out the taxes. What about the net capital spending? That is the ending net fixed assets minus the beginning net fixed assets plus the depreciation. So typically, if depreciation was 0, all that we have to do to find out the net capital spending is take the ending fixed assets, subtract the beginning fixed assets. We want to add back the depreciation because, again, depreciation is not a cash flow. That is mainly for accounting purposes. Now, changes in net working capital is ending net working capital minus the beginning net working capital. So for this firm, the cash flow from the assets is $87 million. What about the cash flow to creditors? If you are a creditor to the firm, there are two ways you can get paid. One is the firm can make interest payments to you, and the second is the firm can also pay you back the principal payment. Now sometimes rather than pay you back, the firm might issue new debt, in which case as a creditor you are giving more money to the firm. What about the cash flow to stockholders? The cash flow to the stockholders comes in two ways. One is the dividends paid, and the other is the firm buys back the stock. Again, money goes to the stockholders. But when the firm sells new stock, again you find that cash is going from the stockholders back to the firm. So the cash flow to creditors is the interest paid minus the net new borrowing, and the cash flow to stockholders is the dividends paid minus the net new equity issued. So all that we are trying to do now is we want to check to see whether the cash flow identity solved is holding. So cash flow from assets is equal to cash flow to the creditors plus the cash flow to the stockholders. So this slide summarizes some of the things we talked about, and you might be taking an exam in class or you might be taking an exam at home. In either case, I think it's very good to have a formula sheet, and as part of the formula sheet you want to include these things. The cash flow from assets is equal to the operating cash flow minus the net capital spending minus the change in net working capital, and operating cash flow is given by EBIT minus taxes plus depreciation. How do we define net capital spending? How do we define changes in net working capital? And how do we find out the cash flow to creditors and the cash flow to the stockholders? So like I told you again, there's a very high chance you get a few questions in the exam and so on. Okay. So let's look at this firm. Let's look at the financial statements. So current account is current assets was 3,625 in 2007, and it is 1,787 in that is the liabilities. So if you look at the working capital in 2007, that is going to be 3,625 minus 1,787. That gives you the net working capital. And if you look at 2006, we want to do the same thing. So that is going to be 3,596 minus 2,140. Okay. And if you look at the fixed assets and depreciation, the fixed assets is 2,194 in 2007, and it was 2,261 the year before. And when we add back the depreciation, that gives you the net capital spending. Now we also are given the long-term debt and the long-term debt in both years and the common stock. So here, once we have that, we can find out some of the things. So what is the operating cash flow? The operating cash flow is given by the earnings before interest and taxes minus the taxes paid plus the depreciation. Okay. So here that way we can find out the operating cash flow. The net capital spending is the change in the equipment. You want to add back the depreciation. That gives you the 433. And the change in the net working capital is the working capital in 2007 minus the working capital in 2006. So the cash flow from the assets is given by operating cash flow minus the net capital spending minus the change in the net working capital. That gives you 331. What about the cash flow to creditors? The cash flow to the creditors is the interest they get. That is the 93. You also want to look at the change in the debt. And the change in the debt is 538 minus 581. So basically here what we find is that the firm has actually paid off some of the bonds. So the change in the cash flow to creditors is 136. So 93 million they get because of the interest payment, and 43 million they got because the firm has paid off the bondholders. What about the cash flow to stockholders? The cash flow to stockholders is they get dividends, which is 285, and when you look at a change in the long equity, that is 90 million. So the firm has actually issued $90 million worth of bonds, sorry, stock. So 285 is the dividends minus 90 million, which came from the stockholders back to the firm. So that's why the cash flow to the stockholders is 195. And now what we want to do is we want to check whether the cash flow identity is holding, and it certainly seems to hold. Okay. Now, what is the difference between book value and market value, which should be used for decision-making purposes? So the right answer here is we want to focus on the market value. And book values are coming from past history. They are mainly for accounting purposes, while market values tell you what people are actually willing to pay. What is the difference between accounting income and cash flow? Why do we need to use, which do we need to use when making decisions? So accounting income, again, is mainly for tax purposes and accounting purposes, while cash flow is really telling you how much cash the firm is generating. So all said and done, at least in finance, we place more emphasis on the cash flows. What is the difference between average and marginal tax rates? Which should we use when making financial decisions? So average tax rate is you're going back, let's say, over the last quarter, over the last 6 months, over the last year, and figuring out how much money we made and how much we paid in taxes. So the taxes paid divided by the net income, that is the average tax rate. On the other hand, marginal tax rate tells you for the next dollar how much the firm has to pay. How do we determine the firm's cash flows? What are the equations, and where do you find the information? So we talked about finding out the cash flows is given by the operating cash flow minus the net capital spending minus the changes in working capital. We also talked about how we can find out each one of these items. The operating cash flow, how we figure that out. How do we figure out the net capital spending? And how can we figure out the changes in the net working capital? Okay, so as I told you before, I think this is a very important chapter. You want to spend some time making sure you're comfortable with the material we covered so far, and you definitely want to, go back to my courses. I have quite a few problems there. You want to take a look at that, see whether you can comfortably do that, and then try to complete the problems on Connect. Okay, good luck. Take care.